friends, a very warm welcome to my channel. In this video, we are going to talk about a company called Data Patterns. This company is into defense and aerospace sector. It is a research driven company with huge order books. It's going to be a very interesting discussion and I request you to watch this till the end. If you are new to the channel, please do subscribe and hit the bell icon to get all the updates of the new videos which I upload. And before we begin, there is a small disclaimer. Whatever we discuss is for educational purposes. This is not a recommendation which I am making here. All the stocks which we discuss are chosen by the audience itself in a Telegram poll. I am a SEBI Registered Research Analyst and I or my clients may have positions in these stocks. My views might change based on the developments in the company every quarter. And this is only a crisp video which I am trying to cover the important points in the next 8 to 10 minutes. This is not a full-fledged deep dive video. So let's begin. This is the flow of our discussion. We'll talk about the business model in brief. We'll look at the charts. We'll talk about the financial performance of the company. We'll discuss why the stock has corrected from the highs. We'll look at the outlook of the management going forward. We'll talk about the valuations, the risks in the company and form an overall view on the stock. So Data Patterns was formed in 1998. It is a research-driven company with 1,500 people working. Out of that, almost 1,000 people are development engineers. So there's a huge team working on developing new products. It's an end-to-end company. They do right from the design stage, development, delivery, testing. So they do the entire value chain. And the products which they develop are used in the defense and aerospace sector. When we talk about some examples of their products, their main revenue comes from radars. They also make electronic warfare, communication systems, etc. When it comes to their customers, majority of their orders come from the Ministry of Defense, DRDO, and some public sector undertakings like BEL, HAL. A part of the revenue also flows from private companies as well as exports. These are some photos of their products so that you get clarity as to what they make. They make radars, they make electronic warfare, and like this, there are several other technologically advanced products which the company is working on. When you talk about their customers, close to 47% of the orders comes from BEL. DRDO constitutes about 20% of their orders, so there is some level of customer concentration in their revenue. In terms of products, majority of the revenue, close to 47%, comes from radars and all the other products constitute the remaining 50%. If you talk about the stock performance, the stock was consolidating in the range of 500 for some time and then due to the consistent performance by the company, they gave a massive rally up to 3,500. The company also raised a QIP fund at around 1,000 rupees. And right now the stock has corrected from the top, from its high of 3,500 and consolidating in the range of 2,200 rupees. This 2,000 base is a very strong support zone for this stock and this is difficult to break unless the company completely messes up its business going forward. When you talk about the revenue, in the last 5 years, the revenue has grown from about 225 crores in FY21 to almost 500 crores in the trailing 12 months. So they have doubled the revenue in the last 5 years. Similar pattern you can see in EBITDA. In fact, it's slightly better. They did an EBITDA of about 92 crores in FY21 and they have done 225 crores in the trailing 12 months. In terms of margins, it's a high margin company because it's a research driven niche business. They are doing EBITDA margins in the range of 38 to 43%. In fact, most of the time they are doing EBITDA margins above 40% except the year in FY23. Usually this EBITDA margin changes for this company based on the product mix of the orders which they deliver in that particular quarter or year. In terms of gross margins, this company does about 76%. There are rare to find businesses with this kind of gross margin. And they have done a QIP of 500 crores at 1220 rupees in 2023 after the IPO. It is about 14% as the company keeps doing capex quite often. Promoter holding is about 42%. So if they continue to raise further funding, the promoter holding may fall down. In terms of inventory, they maintain very high inventory of components and after production also they hold the inventory for a long time because the approvals sometimes take a very long time from the customer side. Similar pattern is also seen in their data days are higher because the payments are delayed. Because even after the delivery, the customer has their own in-house testing process, they test the equipment and then the payment goes through a long process. What is the reason for the fall in the stock price from this 3,500 levels to 2,200? Last 4 years, the company has done pretty decent growth. They have grown more than 20-30%. But in the trailing 12 months or especially in the first half of this year, you see some degrowth in the company. In terms of order flow also, the order flow has been very weak. So there is an uncertainty whether in the second half of this year, the growth will pick up or not and the order flow will be back to the normal or not. In terms of valuations, at one point of time, the company was trading at almost 100 times the earnings. So these kind of valuations are also not very sustainable. That's why the stock has corrected from the top. Before we move on, if you're not a part of our Telegram channel, do join today. It's a free channel. Every day morning before the market opens, I share my views on the market. To join a Telegram channel, search my name on Telegram and you'll find a Telegram channel with more than 6,000 members in it and we can be connected on a daily basis through this channel. Now going forward, what are the growth plans of the company? The company wants to move up the value chain and develop newer products, expand their product range, make higher value products, bid for higher or bigger tenders so that the company can grow faster. In terms of geography, they want to spread across the globe. They want to continue their investments in research as well as capex. The management is confident of delivering better H2 than H1 and be on track to deliver 20 to 25% growth in FY25. And presently, their order book is around 1280 crores, which is more than 2x of their FY24 revenue. In this year, which is FY25, the company expects a total order inflow of about 700 to 800 crores. So H2 order inflow is going to be much higher than H1. And after this, from in FY26 and 27, the company expects an order inflow of almost 2,000 to 3,000 crores. The company is targeting a market size, or the industry in which the company operates or the products which they make have a total addressable market of somewhere around 4.65 billion. And this is growing by 9% every year. In terms of revenue growth for the next 2-3 years, the company is confident of delivering 20 to 25% growth. In terms of margins, they are targeting margins of 35 to 40% consistently. They will develop newer products, bid for larger tenders, and do a capex of somewhere around 150 crores in the next 2 years. Now let's talk about the valuations. In the trailing 12 months, the stock is trading at a PE of about 67 and price to book of 9.2, market cap to sales of about 24x. So in terms of valuation, it is not a cheap stock. It's a niche business, research driven company. So these kind of companies are not available at a PE of 20-30. So we have to pay some premium for these kind of businesses. But at the same time, the re-rating in the stock multiple is already done. So from here onwards, the return will be more or less equivalent to the growth in the profits of the company. So if somebody is looking at a return of 25-30% every year, if the company delivers that kind of a growth, similar returns can be expected from this stock going forward also. Now, when we talk about the risks of investing in this business, in H1, what went wrong? The company had certain orders, but the orders did not offtake. The customer delayed the delivery of the orders, which led to the shifting of orders or shifting of revenue in H2. Like this, there could be delays from the customer side in terms of delivery, in terms of payments. This is the main risk in this business. And this is a high working capital business. Technology wise, they have to keep upgrading. Otherwise, it doesn't make sense by the government and the PSUs to buy from these companies. How much budget does the government allot for the defense sector? What are the policies which the government takes? So these kind of decisions impact this business of this company largely. And sometimes this could be a lumpy business wherein they do very good in a particular year and the business cools off in the next year due to the reasons which we just discussed. So now that you've discussed the business model of the company, you've understood the financials, the valuations, the growth aspects, what is our overall view? If you are invested in this company for a very long time, you should continue to hold because there is a clear visibility of growth for the next 2-3 years. If you're looking at fresh investments, then as the valuations are not very cheap, you should accumulate on a gradual basis. But at the same time, this is a good sector to invest. It is a good company to invest because it's a research driven company developing new products and they have a clear visibility of growth for the next few years. So that's about data patterns. I hope you like the short video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names in the comment section. Thank you for watching and have a wonderful day.